I had some technical difficulties.
Here we go. Einat, let's jump right to it.
I don't want you to introduce yourself, Dror. That would be just blasphemous. So I'll be happy to do it.
Please, the stage is yours.
Okay, perfect. So apologies for the delay, everybody. I'm Einat Maisel. I'm a partner at Fenwick & West. If you don't know what Fenwick is a leading, in my view, the leading tech and life science firm in the world. I'm also head of the firm's Israel practice, which is a very robust and active Israel practice. We're well known in the US and in Israel. We've done more than $500 billion in Israel-related M&A transactions, and I don't even know how many billions in equity financings. And we're really the leader in helping Israeli companies, Israeli entrepreneurs and founders find their way to the US market and help them with all of their growth and expansion needs. I want to introduce Dror, of course. Dror Sculler, who is the CEO and co-founder of Intuition Robotics, a company that's reimagining the relationship between humans and machines, best known for LEQ, its social care companion for older adults. Previously, Dror was Senior VP of Alcatel-Lucent, where he founded and was general manager of the cloud business unit. And before that, he was global head of innovation and corp dev for the company. And prior to that, he was sitting probably where a lot of you are sitting and founded and ran 3 other successful startups. He's a graduate of the Israeli intelligence unit, 8200, and has an MBA, and master's in marketing. So with that, I'll turn the Zoom over to you, Dror, and again, apologies for the delay.
No worries. Thanks, Einat, for that super kind introduction. I'll just say, for those of you that don't know Intuition Robotics, especially if there are people looking for work here, please check it out. We build a super cool robot that takes care of older adults. We're a team of 87 people, raised $58 million from amazing investors, and are trying to help make the world a better place, or at least for older adults, which during Corona is super important. All right. So rather than introduce our panelists, I think we have an unbelievable panel here of 3 great investors from top VC firms. So if maybe Dror, if you can start and tell us about NORWEST and yourself.
Sure. NORWEST is a fairly large venture capital firm. We invest from a $2 billion fund and manage $10 billion. We invest in all stages. Most of my investments are first money in a company, all the way to pre-IPO, growth equity investments, and so on, in multiple geographies, Israel, India, and the US, and many domains. And my responsibility at the firm is to invest in Israel. We invest in companies like SolarEdge, Gong, Vast Data, and so on. And that's our practice.
Right. And Anne?
Hi, I'm Anne. I'm an early stage venture capitalist at Floodgate. I learned literally everything I know about venture capital from Izhar Armony, so I'm excited to share the stage here with him. The other interesting fact is my last trip was to Israel right before the shutdowns happened, and so it's one of my favorite trips ever in my entire life, and so really enjoyed getting to see Tel Aviv, going to Jerusalem, floating in the Dead Sea. So really excited to speak to the audience here.
Thank you. And Izhar, if you don't mind.
You know, there was this cliche that, you know, good managers hire people that are better than them. And we all say that as a cliche. We don't we think we're better than anyone else. In Anne's case, it is absolutely true. She kicks butt, and she is one of the best venture capitalists that I know, and Fortune magazine and other people have said that themselves. So we're very fortunate to have Anne, even if it was for a short time many years ago when we were all kids. CRV is a really long time venture capital firm. The firm was started in 1970, so we celebrated our 50th anniversary just when Corona started last year. People do ask me whether I'm a co-founder of CRV, which is very insulting. I was 7 years old milking cows in a kibbutz in Israel when the firm was started, but I didn't join them 24 years ago. I've been very, very, very fortunate to be venture capitalist in a great time of innovation and expansion. My focus area is mostly enterprise software. And I cannot say that I cover Israel per se. We are truly an early stage firm. We do a third of our projects as seed and the other 2/3 as Series A. But in Israel, we love working with the local VC and ecosystem. So we tend to invest slightly later with Israeli companies. So anyone at CRV, actually almost all the partners have had at least one Israeli investment over the years. We've been fortunate. Right now, we are involved with Zerto and Cybereason and several others. But our view about Israel is that we want to make the best investment, find the best startup in any industry. If it happens to be an Israeli company, that's better. But that's my view. But we will not just make an Israeli investment for the sake of Israeli investment.
Awesome. Okay, great. So let's jump right into it. And the context of this conversation is we have hopefully predominantly founders here. Some are online right now. Some will probably see a recording. So the idea is to have just a frank and open discussion because we are Israelis with Anna, I guess an honorary Israeli working with Izhar for a long time and be floating on the Dead Sea. So let's just talk openly about the topics that are apropos in founders' mind and get kind of leverage the amazing perspective that you guys can have to offer for us. And you know, in this day and time, you have to start with SPACs, right? And when you look at kind of the exit scenarios up until a very short time ago, you really couldn't go public as a startup. You had to be an established company. I mean, like Uber, you know, Airbnb just went public, for God's sakes. And all of a sudden something happened, the flip got switched, and people are going public via SPACs extremely quickly, or in the Tel Aviv setting are also getting hounded by bankers to try to go public in the Tel Aviv Stock Exchange. So the first thought, and we'll talk about kind of boards and so on and how founders should think about this, but how does that meet you guys as venture capitalists? How does it make you change your calculus on valuations that you're seeing, on the type of risk you're willing to take? It's like it completely breaks the normal cycle of growth and so on, and then maybe talking about an IPO when you're a real mature business, right? So how does that find you guys?
I can go first. Okay. We invest as context, you know, at the pre-seed or seed, and predominantly, and I don't think it really changes our calculus, to be honest, because again, like our belief is that these companies we're investing in them for the long haul. We're not investing in them for the exit, and so most of ours do not exit within the next 2 to 3 years. So our current economic climate has absolutely no impact. So where it does have some impact is actually the valuations that we're seeing companies raise at. But I think some of that is impacted by the fact that people believe that tech is not just sort of a thing that's happened. It's a fundamental shift, and you can actually build not just, you know, $1 to $2 billion market cap businesses, but now $100 billion market cap businesses. And so, you know, when I first started at Floodgate, we were making investments into my investment into Lyft was a $700,000 investment at a $5 million valuation. We got into Weebly at $2.5 million valuation. I mean, it was crazy. And you just don't see those anymore, to be honest, at the stage that those companies would be at. And I think we're at peace with that, but what do we actually invest into? What is our exit expectations? Those are not moved by the market dynamics of today.
Awesome. And if we, yeah, go ahead, Izhar, you wanted to add?
Yeah, I think the SPAC is I mean, it's been around for many years, but this current incarnation is so new and moving so fast. So there are lots of misconceptions. One thing I will politely disagree with you that anything can go public. So forget about late stage investing. I don't think that's true at all. I think what we've seen in the last year are two very specific kind of companies that do go public, otherwise they could not. You have the deep tech, incredibly exciting future if it happens, meaning the technology is not even there, like Virgin Galactic going to the moon is one of them, or Nikola, which is, automagical, electrical or hydrogen trucks that don't even exist today. And those have been incredibly difficult to finance in a traditional like VC late stage because the revenue are 5 to 10 years from now. So those do go public via specs. And I view it as net positive if the public is willing to play the venture capital game. And many in the public actually do want to do that. And just for regulatory reasons, they could not. That's a perfect match. Investors are taking risk, but the upside is unlimited. The companies are being funded. What's not to like? So you see many of those like deep tech companies. And the other is the companies that could be public, but could not have gone public. That's kind of a subtle difference. Like they don't have the explosive growth that will just ignite everyone's imagination and the bankers, the top bankers. But think of that again, like those bankers have been gatekeepers for way too long and dictating to the public what they can and cannot invest in. And also taking unbelievable fees and mispricing IPOs, a lot of problem there. So those companies that could be public is a more mature company that have hundreds of millions of dollars revenue, they may be profitable, just don't have the growth. They go public via specs too. And again, that's goodness. Now, the question now, and we are seeing it with some of our companies, if it's so interesting, why can't a company that might go public a year from now or 18 months from now, a normative IPO-bound company, shouldn't those companies consider specs too? Because they could have public currency 9 months, 18 months earlier. The stock will be very volatile, but they're really kind of skipping the last round before the IPO, and they're combining the IPO and like a pre-IPO round into one pipe spec round. That's very interesting. We've seen very few companies like that. Maybe Nextdoor is one example, or SoFi is one example of good companies, not explosive growth, but reasonable growth that could have gone public in a reasonably short time, but decided to do spec. Those are interesting. They're probably not relevant for a bunch of people on this call, but I really want to kind of, in my opinion, the autonomous that all of you guys are aware of are not the norm, and those things probably will not end up well.
So when you guys discuss this on the board, right? You're in a board meeting, and the founders come to you and say, "Hey, these sponsors of SPAC approached me, and they have $250 million. And by the way, they're just this quarter about $40 billion were raised, and so on." And the normal route would have been for this company to raise gross capital and to, I don't know, call it a $50 million round, continue to grow the business, hit the fundamentals, show a few quarters of history, et cetera, et cetera. Help us understand the dynamics in the boardroom. Like, what is your advice to the founder? How are those discussions taking place? What are you considering? There's obviously a great environment right now that might make sense to take part on while the party lasts. But then there are the fundamentals of just building the business the right way. Give us a glimpse of what's happening in the boardroom.
So I'm not on any board that has SPAC right now. That's going SPAC, and so I can't give you first-hand feedback, but I can just imagine how it's going to look like, because a lot of our companies either went SPAC or are on the path to go SPAC. So I hear it from my partners as well, and it's tempting. It's tempting because it looks like a really fast way to generate liquidity to management and to the investors. So everybody's tempted to go this way. But the question to be asked is the company ready to be a public company? Is the management team ready to and want to be a public company? Because it means a lot of things when you become a public company. And if you don't perform well, you get to the penalty box for a long time. And if you have good visibility to your business and you think that you'll perform well, which is what good public companies do, then you're ready to go public in a traditional way. You don't have to go through SPAC, right? And by the way, the idea of SPAC is not new. Look at what happened with Australia. I know a bunch of Israeli companies that were tempted to go exactly the same path in Australia, and through a pipe, and a lot of them are stuck right now. And I think the same thing will happen to a lot of the companies that go public premature and rushing into it, and will be in a penalty box. And then the problem then, once you become a public company that has very low trade volume because investors lose interest, you're a dead man walking. It's really hard to become a private company again. And that's a big risk. So nobody knows how long this window is going to last. And if it's going to be a long window, then people will make money along the way with all kinds of SPACs that should not be public companies. But eventually, I think that a lot of these companies that go SPAC will be in a penalty box.
Sure. Izhar, you mentioned kind of when we were prepping for this, there are a few companies, no names, obviously, that you are exposed to that are going through this process. So anything to add on top of what Dror mentioned?
I think there's so many things to talk about here, but I would say as a future board member, any of us of a company that you have to sit on the board and do quarterly earning calls and be locked in the stock and be very fearful of the situation Dror described. The real question: how do they how do they trade? And we actually don't know, because every SPAC deal is bespoke, is very, very different. There are lots of negotiations, and because of that, I suspect that many of them have pretty long-term lockup agreement for founders, employees, and VCs. So you see volatilities, you just don't know whether people are getting out. I suspect they don't. I've seen a SPAC that was very, very attractive from a pricing perspective. You could raise for that specific company a lot of money at what seemed like extremely high valuation, price to perfection. The caveat was that no one sells anything for a year and a half. A year and a half is just eternity. So you rather really be a private company. And that thing, we need to see more data. Again, it may not be all negative. I think, those companies, if the alternative is that they cannot raise any capital, they should do it anyway. Because the job of an entrepreneur, anyone on this call, is just to freaking raise money for their company, period. Everything else, the price of dilution, is a second or third derivative. So there are companies that I really, really recommend that. I'm happy it exists. It's just that for the normative companies, we don't know how they trade. But it may very well be great. Let's talk about the IPO and the bankers that had a oligopoly on this industry for freaking 70 years, whatever. The last year has shown us, last 2 years, that they misprice everything by like 50, 80%, which means, it's not a coincidence. they're not stupid. They are giving a lot of money to their clients who are Fidelity, Putnam, T. Rowe Price, not the company. You think you're the client because you're paying the fees. Guess what? You're the product. You're the product paying the fees while the clients are getting a gift. So that industry is sick by itself. And yeah, I love the fact that there is that pressure on them.
Izhar, the question if that's the right way to fix it through SPACs. The issue is there for sure with the traditional banks, but I'm not sure the SPAC is the right way to fix that.
Yeah, because I think the banks are also making some pretty nice fees on even the SPACs. They figure out a way, right?
Yep, they always do.
And anything
but at least this process of negotiating much more deeply with a banker / investor, they have their own money, they have their own kind of equity, and then them having to go through a much deeper price discovery through a pipe. Make sure that you price it much, much better. That's a change, right? Versus a banker in a suit showing you all kinds of spreadsheets and say this, and the next day it's that.
I think what's interesting that like the SPAC is actually a moment in time. It's a financing round, but the SPAC actually has a huge implication that you're a public company, right? And public companies, their shares are out there, and the way the investors interact with the company is totally different than in a private situation. And the thing that I'm concerned about is, are the founders actually ready for that? Is the management team ready for that? Are they able to handle both the requirements of a public company as well as the expectations? And so if you just see it as free money and you're just sort of raising your next round of financing about that way without thinking about the potential implications, I think that's the real danger.
For sure.
All right, so let's move to another topic, and related though, which is the buoyancy in the market. So this is a great time to be an entrepreneur. Israeli companies raised last year more money than ever before, even though it was during COVID. Valuations are good. Up until a few days ago, if we delete the last few days, the public markets have been going well, interest rates have been low, great. When is the music going to stop, do you think? Or is it going to stop? Is this just a moment in time that interest rates were so low that nobody had where to funnel money, and we sure growth stocks and they were going up and they, all of that tune? Or thanks to things like, I hate this buzzword, but AI, which is now deployed in every industry, and other technology barriers and digitalization that was unlocked a lot because of COVID as well, did we actually just move into an area where there's more need for technology? There's just a bigger piece of the pie is getting used by technology companies and creates an opportunity for technology companies in industries that it was locked before, or new areas in technology. Bottom line is your thesis that the music is going to stop, we should start getting ready for a winter, or actually is this just the beginning because of fundamental changes?
I can start, I guess. We don't know. Nobody does. I'm here in the Valley, and I heard so many smart VCs in March, gray hair type of people that say, this is it, this is a recession. They guided the boards, and they're very prestigious VCs, guided the companies to lay off people, cut the burn, because we are into a recession. And look what happened since, right? And so bottom line, we don't know, okay? But here's my analogy to what's going on right now, because right now, the situation is absolutely crazy in terms of multiples and the way investments are done. Everybody wants to be a VC, too much money in the business that is being deployed irrationally into companies at unbelievable valuations that don't make any sense, any business sense. So it means it's destined to pop this way or another, okay? So the simple analogy is, imagine that you are blowing a balloon and it's getting blown and blown and growing. Because what happens? People are doing exits, they go SPAC, they go IPO, they have more money, they want to deploy their money, they don't have where to deploy their money, right? Because the bank doesn't give you anything interest back. So somebody tells them, hey, there's a SPAC here, there's a SPAC there. So the money keeps flowing. And that's really where the balloon keeps getting bigger and bigger. Now, when the balloon is like that, and I tell you when it's going to pop, you don't know exactly, but you keep seeing it's getting blown until at some point it gets blown away. And so we don't know, but it's not too far away from now. That's my guess. And we said that the market is in the longest bull market ever in the history of Wall Street. Okay, but 5 years ago we thought that it's going to to go away. I can tell you that one of the managing partners 5 years ago told me that he guided all his companies to go and raise funds because the market is going to fall. And then 5 years from now, and many rounds after, and much money spent, we're still in this kind of market. It's getting bigger and crazier, right? It does get closer because the things that we see right now are completely irrational. So I think the balloons sides are thin, okay, in the analogy I gave before.
I guess from entrepreneur CEO perspective, though, it doesn't really matter. Your job is to finance the company so you can live another day. Then the future is so uncertain, as Dror just said. So I think in that sense, your job, the 30 odd people on this call, is to raise money for the companies, and it has never, ever been better time for that. And then life will happen. Like Dror, I stood in front of our LPs for almost 10 years, and I told them the music is going to stop. And I'm so glad that my partners did not listen to me and continue to deploy capital, because they made amazing investments. Like I have a DoorDash already into that. Like I never believed that we'll have a bull market for 11, 12 years. But so we don't know. We do have a problem because we have to return capital to our LPs. So like Dror said, investing into a clearly soon to collapse bubble is a very risky thing, but it's not your problem as the attendees. You guys take advantage, raise money, and then we'll see what happens.
Starting to see your LPs commit less than they did in previous years?
The opposite. Sorry, I'm monopolizing the call, so I'll say something and shut up. The opposite, exactly the opposite. They have what's called the denominator problem, meaning once their publicly traded equities are going up, they feel in a very odd way, they know that they are underallocated to private investments, PE, real estate, and venture. That's the bucket. So we tell them the prices are insane. They say, doesn't matter. Wall Street is very high too. We need to have 20%. So here's another 10 billion. I mean, not to CRA, but to the industry. And that's how financial markets work.
It's interesting because so my second day of work at CRV was 9/11. And so I've seen sort of the downturn, and one of the first projects I worked on, Izhar, I don't know if you remember this, was the capital overhang project, which was to determine whether or not there's too much capital and venture capital at the time, and which feels cute now because I remember the order of magnitude is just completely different. But one of the conclusions that I came to was at the time, which was wildly incorrect, was that a large number of these venture capital firms would go out of business. This is back in 2001. And when I went into grad school, I went to a PhD program. And as I was looking at some of the numbers in 2007, 2008, it was a starting up Floodgate, I was shocked to figure out that most of these VC firms, like there are only a handful that went out of business. Most of the ones where I had personally pegged that one is going to go out of business, still around, and so the capital is really persistent in a way that is not sort of representative of a capitalist society. And I think it's gotten worse because there's sort of this Hollywoodification of venture investing. And in fact, in the last year, where I thought the denominator effect would go into effect, because then if the public markets collapse, then they're like, we have to get out of venture. That didn't happen, right? Like you heard the opposite, exactly what Izhar is saying. And so they started putting money into even solo GPs, which they never did before. And so it's just interesting to me because like the market is expanded. It's exactly what Izhar is saying. From an entrepreneur's perspective, go and raise the money. But from a venture investor's perspective, you have to be careful because we have to return the cash. We can't just keep taking it from our LPs. We have to provide returns.
I still want to push a little bit on the macro view. So yes, we all should raise money while we can, absolutely, and nobody can predict the future. Agreed. But I want to push a little bit on the macro view. I mean, 10 years ago, right? You look at the top 10 in the S&P 500; they were not tech companies. They are now, minus Warren Buffett's company, which also invests in tech companies. You look at the type of startups; they were mainly providing software or consumer internet companies. You look at it now, you have a tech startup that happens to be an insurance company. You have a tech startup that happens to be a health insurance company. You have, like, all of these industries are fundamentally changing, and investors and founders have appetite to actually not sell into existing companies, but actually build new companies and go after the incumbents in ways that at least I haven't seen before. But I'm from the entrepreneur side. I spend all day like working with my engineers and from time to time look at the market. You guys are the other way around. So try to help us understand the macro view. Is there a fundamental shift? Is tech going to take a bigger piece of the pie? And therefore, yeah, valuations up or down, but directionally, this is a growth industry for the foreseeable future? Or is it just over appetite, over eager? We're going to see ourselves going back to fundamentals, and tech companies should build software and sell them to existing companies in their businesses instead of being a better X than Y.
I think it comes in cycles, Dror. I remember a story of one of our managing partners. He was raising funds in the 80s, and he was told, people told him, what, there's no potential there because all the client server technology back then kind of matured, and they said, what new technology would come in that you can invest in, right? I remember when I joined NORWEST in 2007 or 8, it was, people were saying everything is moving to the cloud. You can't build technology anymore because it's so easy to build technology. So everybody can build one, right? And so it's really hard to build deep tech companies anymore, right? Because everything is so consolidated. Every young 18-year-old entrepreneur can build any application they want, right? And obviously that's not the case. So technology reinvents itself in cycles all the time. And we're in the digitization cycle as well for enterprises. That COVID just, accelerated the process, okay? Is it going to be, kind of exponential growth the way people envision? Probably not. Is it going to be a growth because technology is important and making things more efficient? For sure. Does it mean that the world will have so many unicorns in 5 years from now? Probably not either, right? So everything adjusts to norms eventually.
Right.
If I might add, there's no doubt among us panelists, you, Dror, too, and I'm sure the entrepreneurs here, that we are in the early innings of a great secular value creation that Mark Andreessen was right. Software is eating the world. So software from a tool becomes the business, exactly as you said. No one doubts that. It will go on for a long time. The confusing factor is evaluations. And I think valuations have nothing to do with that secular growth. I think valuations are 100% tied to interest rates. And I grew up in this industry in the 90s where interest rates were high. They were like 6 to 12%. And that meant that very good enterprise software companies were trading at 3 times revenue. And it was great. It was very good. If we get there, we're home. And then, somewhere in the 2000s, for a bunch of reasons, interest rate dropped to like single digits and like 3%, 2%, even 0 for a while after 2008. And we, after that, started to think of a 10x, not revenue, ARR, as a great kind of middle of the road valuation. That's a 3 times more value for exactly the same thing. And now it was COVID. We effectively have deep negative rates. We don't understand that, but when the Fed is throwing $1 trillion, I'm guessing that's more than the annual budget of Israel. I don't know because there's no budget. but if there was a budget, $1 trillion, not like into small businesses or welfare checks, actually buying directly stock in the stock market or ETFs, investing in the stock market to keep it alive, which is effectively really reducing the price of equity. Now we're talking as a norm of 20x, next 12 months ARR. Those are just concepts in our mind. They don't have nothing to do with reality. That is the part I think that you are alluding is kind of a risk. All of us understand that. But again, like, how can a single entrepreneur change that? She cannot. She just needs to raise money for a company, live another day.
Great. Okay, so let's go back, unless Anne, if you have something to add. No, great. So let's go back, zoom into the individual entrepreneur, and let's talk about boards. So the makeup of the board is super important. Beyond the makeup of the founder dynamics, probably one of the key factors for success or failure of the company. How would you counsel entrepreneurs to think about how they make up their board? And of course, if you can't raise money from anyone and somebody is the only one to give you a check, then you might have less options. But if you do have options, what is kind of the best practice you've seen there for savvy entrepreneurs and together with their existing board members to think through how to create a great makeup of a board? And even if you have like actual practical advice, right? Like I might from the time that Anne and Izhar were working great together, I might love CRV as an investor, but I might really prefer Anne on my board than Izhar. When Izhar is smiling, maybe it's a good decision even, I don't know. But how would you counsel an entrepreneur to even address that topic with an investor in such a, how should he do the diligence? How should he address it? How should he think about the makeup of their board?
I think actually, so the makeup of the board is pretty critical because these are people that you're going to be working with pretty closely. It's interesting. We went through this actually because we invested in one of our associates who then left to start a company, and we let him choose. And he went through each of the partners and he knew us really well. And what was funny was he didn't choose me or my co-founder, Mike. He chose Arjun, the third person. And we still talk about this. We're like, Phil knows us so well. And how did he choose Arjun out of the three of us? Why was that the favorite? And I think actually Phil went through a really good process. He was thinking through like, these are the strengths. This is what I really need. And so therefore, like my best fit is with Arjun. I think it depends on the fund too, though. So in our firm, we don't have sort of credit given to who sits on the board. And so the financials don't really matter. So if I pass off a deal to Arjun, it really makes no difference to me. It's just he has to take a board seat where I didn't have to. And so it's no skin off my back, right? And so it really depends on the dynamics. So I think from an entrepreneur's perspective, you have to be careful because there are some funds where that really matters and you could really like hurt the dynamics of how your relationship with that firm, if you're seen sort of going around different partners. And so uncovering that I think is important. The second is actually doing a lot of diligence with entrepreneurs who've worked with that partner. I had one recent encounter with an entrepreneur who sat down. She asked me like 5 very specific questions. What is a good exit for you? How do you think about that? What is your working tempo with an entrepreneur? Give me 3 or 4 names of people that you've worked with, one at least that hasn't gone well. And so I thought those questions were really well suited because then we could make sure that we enjoyed working together, which is, important because that's going to be a long-term relationship.
I would add that it also changes when a company matures. And some people have more experience in building the first stages of a company, and some people have more experience in the later stages. So my recommendation to entrepreneurs is, we're doing so much diligence before we invest in you. You should do as much diligence on the firms that you talk with and the partner in specific that is talking with you. And you have to feel comfortable that this partner would be a really good partner for you, just like another co-founder that joins you this whole journey. And it's not hard to diligence, because if you're enough time in this business, you've been through a lot of good times, but more importantly, bad times in your companies. And I would check with every company that this partner has been on the board on, how the partner behaved in bad times and how the fund behaved in bad times. Some funds will run away, say we're not investing anymore, right? And some funds will not help anymore, right? And so, the way people behave in different situations and the fit to the CEO is very important. So everybody should feel comfortable when they pick up a partner, an investor, if they can. If they cannot pick an investor and there's just one fund that is willing to invest in them, it's not such a hard decision. They still should do diligence to make sure that they're doing the right thing. But if they can choose between multiple firms, I would say don't always choose the one that gives you the highest valuation, what looks like, and all the stories that you hear, but really do the diligence to see who has really helped their companies along the way. And it's easy to diligence. It's not very difficult.
And so, Izhar, how would you feel if an entrepreneur says to you, listen, I'd like to talk to 2 companies that you stopped funding, and I understand that there might be good objective reasons, but I want to know if they were objective or they were because of bad board dynamics or bad fund behavior. Would that turn you off from the deal? Would, there's an ego here a little bit, there is
on the contrary, it means that this entrepreneur is doing a very, very thorough work, right? And understanding, and it means that this entrepreneur will do thorough work on everything else, right? So obviously,
it's actually my standard practice. I have a sheet of everyone that I backed. By definition, a real estate investor, at least half of them went out of business. And I'm just saying, call any. I mean, it's too long. It's 40 now, but and 2 people are no longer with us. But yeah, I love that, because it means that we have a good chance of being in the deal if the entrepreneur is kind of engaged. And I very much welcome that, because we try to say that reputation is the only thing we have. My money is as green as Ann's money or Dror's money. So I love that. I would add one more piece of advice different. I encourage every entrepreneur that raises money, even if it's seed stage, certainly Series A, to add an outside director. And it just typically makes the board dynamic better. Many of us, certainly Dror and people that I know, are coming with best intentions. We put the company ahead of the kind of interest of our funds, but the other side, entrepreneurs don't necessarily trust us. It takes a year, 2 years to develop the deep trust. So there's always suspicion. Why are you making that suggestion? Are you trying to, is it a zero-sum game? Take money from me, whatever. So I think when an outsider comes in and has no financial interest, it just makes things better. And sometimes they bring actually great advice regardless. But even just the money versus equity, sweat equity dynamics, it's great to have an objective person. And I'll say one thing here, and correct me if I'm wrong, I understand the story. You were an early board member in Zimrite that became Lyft, but you were a seed investor. So when the big guys came with the big checks, I think you had to leave the board. But then I think before the company went public, or way before, the entrepreneurs asked you to rejoin the board as an independent director. That's my recollection. And it became Lyft, which is a multi-billion-dollar outcome. And that's, I think, is the greatest honor possible, compliment to venture capitalists doing their right job. So it's very, very important to add that outsider.
Yeah, Dror, if I can add one more thing, although I'm not an official panelist. I also think it's really important to leverage your own personal ecosystem and network. So, the people that you're interacting with, your lawyers, your advisors, your, co-founder friends, they've all been through multiple rounds and board meetings and relationships with, you know, a much broader ecosystem. So leverage them when you do your diligence as well.
For sure, for sure. And no doubt, I think a lot of, I don't know if we have time to go into horror stories, but I think those of us that have been around this game for a while have horror stories, how boards just destroyed companies, and usually because of egos between the board members or things that had little to do with what's in the best interest of the company. So, yeah.
That's another point. When you build a board and build the rounds, make sure that you don't create conflict of interest, right? For example, sometimes entrepreneurs will prefer a round at higher valuation that is senior to prior rounds. But what do you know? By doing that, you created conflict of interest between the people who came in the last round and the people who came before that, which is, it doesn't seem like important to the common shareholders, which is management team, but it is important because it starts creating all kind of biases at the board, especially in bad times, right? When people start thinking, okay, where is my position here? And am I protected with my money and things like that? So the lesson learned is make sure that everybody that nobody has conflict of interest and everybody is really focused on the same thing, the success of the company.
Yeah, and I think I fully agree. And I think great litmus test is if you can build a relationship that when you have bad news, the board members are one of the first phone calls you call and not one of the last ones that you dread calling. That's probably a great litmus test to knowing that the dynamics are good. But anyway, so we're talking about board dynamics. There's another set of dynamics, and you're all early stage investors, although not exclusively early stage investors. And any early stage investor you'll talk to will tell you, I invest in the team. And it's the team and the team and the team because the business model will change and the technology will change and the opportunity will change, but the team. And yet, when you kind of fast forward, you see that the founder dynamics actually aren't constant. And as a company grows, there could be friction there, or maybe the company might outgrow some of the founders or what have you. There are very complicated dynamics that can create there. And all of a sudden, this core part of your thesis, the team, is actually put into question. So how do you help the founders through this? How often do you see it happening? What is your role as a, I don't know, marriage counselor? I don't even know how to call it, but like how do you work through these dynamics and how scary is it? How should entrepreneurs think about approaching you with this topic? They're probably really afraid to talk to their board members about this specific topic. What are your thoughts?
I think it's actually just a function of the trust that you have with the founders. One of the things that I like to talk about is that the title founder will never get taken away. And I think you can always have pride in that. But the actual job of CEO, VP of marketing, CEO, all these things that actually evolve quite a bit from start to IPO and beyond. And some people are very good at adapting, but that's like really a small number of people that I've seen. A lot of people are better off in fulfilling the potential of the business to bring on additional team members over time to take over some of those roles. And so it shape shifts over time. I think that the dynamics between different founders is probably the hardest for me. Is some of them like accelerate into those roles, and others they're still sort of that founder mentality, and they have a hard time giving up either control or other things. And I think that's the toughest one. It comes with a lot of emotional ownership of that position. And the relationship can get frayed. But to me, like, I just believe in transparency and honesty as a fundamental principle. And And if you try to skirt the issue, then you're basically waiting for another investor to raise their hand and say it when the company is in a worse position. And so I think that sort of, you can't always be the most liked investor in the room if you're looking for the best interest of not only the company, but also those co-founders as well.
Hard truth. Yeah.
Yeah. Dror, you really need to balance two things here. Ego always plays a role among people, especially if it's your company, right? It's your baby, right? And when ego clashes, that creates an issue. And if the discussion is about ego, it's really hard to solve, okay? Then there is what's good for the company, which is also very important to the founders. The more you tilt the discussion to, let's leave the ego aside, let's think about what's the right thing for the company in terms of roles, positions, decisions, and so on, then you're more likely to be successful in that marriage counseling work. And I agree with Dan. Trust is everything, because without trust, you can't be a mediator.
Izhar, anything to add? No. Great. So we have in the time left, we have some questions from the audience here. The first is, for Israeli founders and Israeli CEOs, do they need to move to the Valley? And maybe I'll add to that, how has your perspective changed over the last 12 months around that question?
I can take that. We used to think that absolutely, like black and white. I think I still think that if a company main market is the US, especially enterprise, but even consumer, I just cannot imagine how you can do the best job possible out of Israel. It's a different culture, different time zone, different language. But there are many, many companies that are truly global. We have one interesting investment in Israel, Upstream Security, that sells to automotive manufacturers that are mostly Asian and European, almost nothing in the US. So why move to the US? But from an investment perspective, and that's the question here, I don't think it's no longer the case at all. I think many, many US investors think of Israel as one of the best places to invest. There is so much capital in Israel, either by US funds or truly Israeli funds. And it's off the table. It used to be on the table. I think it's now off the table.
Dror, so you picked up and moved. You were already a partner of an amazing American VC fund doing business on the ground in Israel, and actually moved to the Valley. I assume to also be close to the entrepreneurs, to the CEOs that found themselves in the Valley, in addition to your home fund and access to capital and so on. So A, is that the reason, I guess? And B, do you see it differently now?
Yeah, I moved here for multiple reasons, but before COVID, I used to fly to Israel for at least a month, a quarter. So I see myself on both places. And I was doing Zoom calls way before COVID at 6 a.m. and 7 a.m. in the morning, or 10 p.m. or 11 p.m. my time. So that's not foreign for me. It's something I was used to do before. So I didn't feel that distant. Also, we have an office in Israel with an senior associate. And so we kept the same practice, basically. I moved here for multiple reasons. One of them was to help our companies, when they grow, recruit the best management team on the go-to-market, and help with that creation of global management team, especially when the entrepreneur is either in Israel, the CEO is either in Israel, or moved to the US recently. So that's always a challenge, to build a very strong management team. And if I can help, it's much easier to help that from here and build bigger companies when we build really strong management teams. So that was one big reason that I moved here.
and as an honorary yet non-true-born Israeli, how do you see this?
You know, so we're really excited about Israeli companies. We have only actually one investment. It is incorporated in the U.S., but it's a cryptocurrency company, and it is harder to interact on a regular basis. And so at the seed stage, it might be a little bit trickier. I think as the company becomes, and this is where I would say I would never invest in an Israeli company unless they also had on the ground advisors and angels. Even better, another investor who has good ownership in the company involved, because I think you really can't replace that. I'm just going to pick up the phone and call dynamic, and then maybe we can see each other in person. That said, like the technical talent that we have found in Israel has been unmatched, to be totally honest. And we have one company that's in New York that even has their entire development office in Tel Aviv. And it's been it's such a fast-paced group that it makes me want to invest more into that region.
Great. Well, thank you, everybody. We started a bit late, but we'll finish on time. So if any of the panelists have any parting words that you want to share with the entrepreneurs listening to us, feel free.
Wish good luck to everybody in the journeys.
Thanks for being a great moderator, Dror. Great job.
Thank you.
Thank you.
Thank you.
Right. Thanks for your time. It was very interesting. Thank you so much.
Bye-bye.
Bye-bye.
Good luck.